Good morning, everybody. Welcome to our second session on the IFRS 2 share-based payment webinar. Today, we will talk about further accounting of equity and cash-settled share-based payment plans, talk about and discuss the valuation, and look to how we need to disclose the share-based payment transactions. I think very logical. So I think we will end before 12:30, which is maybe good news for many of you. Again, questions you can ask in the question tab or the chat tab. We will try to respond to them. I see that the handout is not included yet, but I will include them during the call. My name is Sander Faye. I'm a partner at Finvision, and I'm joined with Andres Henebel, who will take also a significant part of the presentation. So yeah, we are at part 2. Don't remember the next sessions we have on IAS 24 related parties, the IFRS update and the ESMA priorities, enforcement priorities from the ESMA, and then we will end the year with earnings per share. Okay. So I give the word to Andres. Go ahead.
Yes, thank you, Sam. So we would like to start maybe just with a very quick recap, just 2 slides on where we were in our definitions, because last session we saw obviously introduction, objective, but also some scope and definitions there, and we ended with a lot of applications on the equity settled plans. Before we dive into the cash settled plans, maybe just shortly the difference between these two. The definitions, cash settled share-based payment transactions are just normal transactions, but where the entity acquires goods or services by incurring a liability to transfer cash or other assets. The liability can be a supplier, an employee, as long as the entity receives goods or services. But the important thing here for the cash settled plan is that the cash amounts that will be transferred are based on the price or the value of equity instruments. Can be shares, can be share options, warrants, anything really. So another thing to keep in mind is the shares or share options do not have to be those of the entity itself. It can also be the shares of another group entity, for example. We have a number of slides detailing some more examples there and the impact on cash or equity settled share-based payments later on for this. Just to make the difference, last time we saw equity settled share-based payment transactions, also share-based payment transactions for which the entity receives goods or services as a consideration, but for its own equity instruments or equity instruments of another group entity. So very important there is it can only be an equity settled share-based payment transaction if the entity has no obligation whatsoever to settle the transaction with the supplier directly in cash. The moment you have that option to settle in cash, it's usually a cash settled share-based payment plan. The second slide of definitions we already saw in session 1. I'll focus on the second part here. A share-based payment transaction. The arrangement has basically been explained by our previous slide with the 2 definitions. But I just want to stress that for share-based payment transaction, it's a transaction in which the entity receives goods or services, so from an employee, from a supplier, anywho, but also incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement. So that can also be when there's a settlement for another group entity that receives the goods or services. So again, when you're in a group and there's a bit more a complex transaction where, for example, there's a subsidiary that receives the goods or services, but the equity settled plans are based on the mother entity or the group entity's equity, that is also a share-based payment transaction. So we have a lot of different possibilities there. We won't go into all of them, just a few basic examples. So A cash settled share-based payment plan. We already went into the definition there, but obviously we will have a little bit of different accounting for the cash settled plans. The equity settled plans obviously had a provision that is accounted for in the equity lines. For cash settled plans, there will also be a provision as a liability, but it's not in equity itself. Also for the accounting requirements itself, we noted that the grant date fair value of equity settled plans always remains fixed. There are no remeasurements for your grant date accounting there. For a cash settled plan, that is not true. There will always be a remeasurement of your liability at each reporting date, and also very important, on the settlement date. So remember the slide we had last time? There were market performance conditions, non-market performance conditions, there are service conditions. Some of those we have to account for by a true up, and we have to adjust our estimates there. Others are already taken into account in a fair value. We do not have that complexity when talking about cash settled plans. For a cash settled plan, the cumulative net costs ultimately should always be equal to the settlement amount. So that's a little bit easier, let's say, because at the end, you always have a true up, and that was not always the case for the equity settled plans. Now, cash settled expense is recognized until settlement. That's also a little bit of a difference there, because we still will be, how do I say it? We will be recognizing our expense over the vesting period. But let's say if the settlement date is 1 year later than the vesting period, that still gives the opportunity, let's say, for the fair value at the reporting date to change. And that will also have to be taken into account. So there's a little bit of a longer period there where the cost can change or have fluctuations, let's say. Maybe just a very easy example here, in line with the examples we already gave last period. So in year 1, we have company B, which is granting some share options to its 100 employees. There's a 3-year service condition there, and if it is met, 1 month after year 3, there will be a settlement which is paid in cash. So basically, the amount of cash will be dependent on the intrinsic value of the share option at the settlement date, and any increase in the share price will lead to a higher payment to the employees. Now, what do we need for our accounting example here is a fair value of the share options at the grant date. This one is important, but also at each of the reporting dates. So here it's a very nice example because at grant date it's only €9 fair value per share option, and it keeps increasing until the last year, and after that it just has a little drop there. So looking at the accounting for the example here, what we see is the amount of instruments for which it is expected that the service condition will be satisfied. Here the company expects that everyone will be remaining at the company, so 100 employees for which the condition will be vesting. Now, the current fair value at the reporting date, that's the table we already discussed here, and simple multiplication leads to our expected total of net expense at the end of the period each time. Now, in line with our examples of our previous session, we have a proportion of the liability which we will be recognizing as an expense over the 3 years of the vesting condition. So for the first year, 1,200 cumulative net expenses, 1/3 of that is 400. In the second year, our fair value has increased, so the cumulative expenses also increase, and that's also seen in the net expense in our current period. The 500 is obviously higher than the 400, and that entails part of an increase in the fair value for the current period, but also for the costs we already took last period. We have a sort of true up there. Now, What is important to note here is in our analysis of the expenses, we see that even in the first year, there's a recognition of our initial liability. That's only 300. So in our first year that we are recognizing it here, we already have a remeasurement of our recognized liability. And that is because at January 1st, when the share options were granted, the fair value was 9. So a total cumulative expense of 900, let's say. But in the first year, by the end of the period, there has already been a remeasurement. So those can be booked separately there. And it's very important there not to forget that the start date is actually 1st of January here. I think that is very straightforward and also a bit with how most people feel it.
Can I, there's some questions on this.
Yeah.
Can we have a look to them? One moment. Let me see. Oh, okay. So people say that, oh, that's technical that you always see the first slide, but I think everybody should, what we see is should, oh, okay. Indeed, you're still seeing the first slide. Is it still the case? Can somebody respond to the questions? Otherwise, we will share again the screen. We share. Okay. Let's see if it works out now. Okay. Yes, I think okay. Thanks. I think it's okay now. Sorry for that. I think all the comments were the same about that. I'm sorry about that. That we the people were seeing the first screen still.
Yeah. So maybe what we can do is just very quickly go back to the example I was explaining. That might be useful if you can just see the figures behind that.
Yeah.
I'll just do a quick recap of that. Definitions might not be as necessary there to recap.
What I will do is I will add also the slide deck now that everybody also can follow. One moment, give me one moment. Okay, the slide deck has been added also to the handout.
Yeah.
Apologies for this. Okay, go ahead, Andres.
So I'll just do a quick recap here on our example we had. So what I was explaining here in our first column, 100 times our fair values of 12, 13.5, 15. So an increasing fair value leads to also an increasing expected total of our net expenses here. And the important part to see here in the example is actually the impact of our cash settled share-based payment plans. We have our initial recognition, which is 400 as 1/3 of the 1,200. The next year, the proportion remains the same, 1/3 of the cumulative expense, but that is an increase in our net expense in our current period. So the 500 is 100 more than the period before due to our fair value increase for the current 2 periods that have been booked, let's say. And here it's very, here you can see it visually now, let's say. We have a recognition of an initial liability of 300, which is €9 times 100 is a fair value of 900, which was actually the total amount at the grant date the plans were issued on January 1st of the first year. So very important here is to remember there's a recognition of our initial liability, but for our P&L, we also have a remeasurement of the recognized liability, which is already in the first year the case, let's say. A quick note still on modifications and cancellations. So this one is actually more relevant to some of the equity settled plans, let's say, but some cases have modifications to the plans afterwards. For example, if there is a crisis, let's say, or a pandemic, after a share option plan has already been issued, management might take the option to set new targets or adjust some of the targets there to keep everyone motivated within the same plan. What we did not discuss last time were some of these modifications. Usually, if they are beneficial, there's a number of different options here, but the main takeaway is if they are beneficial modifications, you will be accounting for the additional fair value that has been granted to your employees. On the other hand, modifications that are not beneficial, those will be a little bit more rare, where you, let's say, it's a little bit unfair to your employees in most cases, but if you decrease the fair value of the option plans they are granted, that would be ignored. So just by decreasing all your targets, you can't erase the costs you have already taken from your fair option of the fair value of the plans. And obviously, non-beneficial modifications also include reductions in numbers. So that's basically just applying cancellation accounting, which is something we already covered in our last session. Now, this is just a very quick example on this. So I won't go into the full details of this, but there's company C, 1,000 options for which the grant date fair value is 20,000. So we will have a period of 5 years. The important thing here is in year 2, there has been a significant decline to the figures. As a result of that, we have deeply out of the money share options, and obviously no one is motivated any longer because nothing they do can still fix the situation. So company C reprices the share options by modifying the exercise price. Instead of the initial 100 exercise price, they will be decreasing it to 40, which is an achievable target. Obviously, a share option with a much lower exercise price will be worth a lot more. In the example here, the fair value of the share option before the modification had been reduced from 20 to 0.1. After modification, it lands on 9.6 or 9.7. So in the initial example, prior to the modification, there's nothing difficult about this. 5,000 instruments, 20 euros worth each is a total expense of 100,000. There will be a cumulative expense until the end of the period that is ramping up. And I think we had another factor here, which is a number of board members. Yeah, one of the board members leaves in year 4. So that's all within our initial accounting for the contract. At the end, in year 5, we had a cumulative expense of 80,000, which is 4 out of our 5 board members' total cost. Now, the important thing here is this table just remains the same. The modification does not alter the accounting for our initial plan. What we do have is we have granted our employees or our board members an additional amount of fair value here. So based on our decision tree, this also has to be taken into account. Year 1, there are no changes in our modification itself. So this table is strictly the modifications, let's say. In year 2, at the moment of the modification, at September 1, we still have the same number of estimate for our vesting instruments there. The total expense, or 48,000 here, would be a calculation of our additional fair value granted. So the decrease of the share price or the strike price here for options has decreased, which creates 9.6 euros of value per instrument. So that's our 5,000 times 9 is 48,000 total costs. And this total cost, we will be recognizing it over the vesting period as we would have done for another contract. So you see the cumulative expense until the end of the period, the amount that is taken into account, it's a little bit lower for the first year because it has been prorated. It's just the number of months here. For the year 3, 4, and 5, it's actually more what we would expect within year 4, the new estimate of a lever, let's say. So basically, if we want to calculate total expenses for the modified contract, we have our initial table, which tells us, okay, we have 80,000 in cumulative expenses by the end of the period, and we had our modification table, which has a slightly longer period over which it runs. There we also have 38,400 at the end of year 6, which is 4 years after modifications. So in order to calculate our costs, we simply have our initial accounting and another table from our modified accounting where we take everything into account. I think modification and cancellations, one of the other things to keep in mind is, I think we already covered this, but it's really important. Cancellations by the employee, we will be accounting for it as if it was forfeited. A cancellation by the employer, that's actually a cancellation. So usually modifications, that's only a replacement or an actually adjustment to the strike price of those options. Another difficult point sometimes is when the contracts become a little bit more complex and there is a choice of settlement. So basically, there's an employee transaction where the employee works and they receive a share-based option plan, but the entity can choose whether they pay this in actual shares or directly in equity, or whether they want to pay this in cash. Now, if the entity has a choice, it's actually quite easy. In the next slide, you can see this. If the entity has an obligation to settle in cash, then it's obviously a cash settle plan. If they do not have an obligation and they can choose, they can pay in cash, but it's not an obligation, then the share-based option plan will be accounted for as a transaction that is equity settled. A little bit more complex here would be the employee transaction where the employee has the choice of settlement. As you can see here, then we need to account for this as a compound instrument. That's something we obviously do not like to hear because it becomes a little bit more complex here. Now, what does this mean for the specific transaction? There will be an estimate on what the chances or what is your estimate how we will settle this. For example, we have 40% chance of settling this as cash and 60% chance of this settling as an equity instrument. Now, those estimates will be used to calculate a fair value of both the cash alternative and the equity alternative, and those will be taken into account. So there's fair value of our liability for the cash alternative that will be accounted for as a liability, just as any normal cash settle plan. The fair value alternative the fair value of the alternative will be accounted for as if it was an equity settle plan. So here you actually have a combination of both accounting treatments, let's say. You will have two different provisions or places of those provisions in the balance sheet. Another thing to keep in mind, especially when you are doing accounting for multiple group entities there, is share-based payment transactions among group entities. I think in the past we always had a simple example where we have an entity giving a number of equity instruments to a subsidiary, to a supplier or to an employee, but usually that's your own equity. Here we have 5 or 6 examples, I think, where we have made it a little bit more difficult. And for example, in our first example, we have a parent company with a subsidiary, but the parent is granting the share option plans. They will also be settling those plans at the end of the period, but the goods and services for whom they are granting these plans, those are actually not received by the parent, but by the subsidiary. In this case, it will be settled in shares, so it's an equity settled share-based payment plan. Now, based on our simple examples here, the only difference with what you would expect is the fact that the parent who is issuing our instruments is not the one who receives the instruments. But if you're in a group, that actually does not matter. As long as the parent and the subsidiary are within the same group, in the parent consolidated financial statements, that will still be an equity settled share-based payment plans. In the standalone financial statements, the same case, and also for the subsidiary. Now, what you will see in our next example, we have changed a few things. And here, it will still be the subsidiary who receives the goods and services, but it's a shareholder who is granting the awards and settling them. Now, for whom does this change anything? For the parent, this is no longer a share-based payment transaction. Why not? They are simply not involved directly. So the only thing for which they are included here is actually to measure the amount of cash that will be paid, but they do not have an obligation whatsoever to pay anything to a third party here. So the shareholder is external in this case. The group is the parent and the subsidiary. And the subsidiary, they do receive a number of services. Even if those services are paid for and granted by a shareholder, let's say, the subsidiary still has an equity settled share-based payment transaction because they are receiving the goods and services, and they will be measured based on this standard. For the parent as a consolidated total, obviously, if the subsidiary has an equity settled share-based payment transaction, the consolidated financial statements will have those as well. So here it's just for the parent standalone figures. They are no longer a party in this, or directly a party in this transaction. Now, here, if it is actually the subsidiary, it becomes a little bit less complex. Let's say the subsidiary grants an award and settles an award. It's based on the parent's equity, let's say, but it's also the subsidiary that receives the goods and the services. Now, again, the parent as a standalone financial statement, they do not have an obligation here. The special thing about this example is the subsidiary who is granting this. This actually becomes a cash settled share-based payment transaction. So if you look here, it's the subsidiary settling for some services and goods, but they settle in shares. Now, why is this a cash settled share-based payment transaction? Because the subsidiary cannot just create equity instruments from another entity, even from the same group. So here, the subsidiary, by giving these share-based payment plans, that's actually a change here to cash settled plan, because they incur an obligation with their parent entity to make a settlement, let's say, for the equity instruments they have given to their suppliers or their employees. Now, obviously, for a parent consolidated financial statements, that's a difference there. There's no difference there. It's still an equity settled share-based payment plans, because there's no difference between parent and subsidiary here. So this is a little bit of a special case, and obviously it also affects your accounting treatment, because at the subsidiary level you have your cash settled plans, but at the parent consolidated level it's an equity settled plan. One of our last examples here, the subsidiary, as in the last example, but also they grant their own shares or their own equity, then obviously they no longer have their obligation to settle with their parent company, and the subsidiary still has to account for this for an equity settled plan. So the difference disappears here because they are issuing their own equity. And I think one of the last special examples here, the parent who is granting an award, settling it, but based on the subsidiaries, so the daughter entities, shares. Actually, again, as a consolidated group financials, that does not have an impact. It's still just an equity settled share-based payment transaction. But for the parent, standalone, this becomes a cash settled share-based payment plan. So this is just a mirror of our example a few times ago, because the parent has an obligation to settle the amounts they have given here to someone else with the subsidiary entity. For the subsidiary, it's still an equity settled share-based payment transaction because they are also receiving the goods and services themselves. And then our final example, the parent who grants the awards, settles the awards, also based on its own shares and equity, but award settlements in shares or cash. So here for the parent, I think that's a very clear example. If you're a consolidated group, it's a cash settled plan. For the parent standalone, that's also the case, but for your subsidiary standalone, that's actually an equity settled plan. So here again, the special item is the fact that the subsidiary here is receiving goods and services, but they themselves, they do not have an obligation to settle it in cash because it's actually the parent who is settling these. So again, here, as you can see, there are a number of examples where the treatment between your different group entities is actually impacted by who is granting, who is settling, and who is receiving the goods and services. So it's really important just to, how they say this, just to map out different possibilities, let's say, keep some guidance with it, and check for each entity itself whether you want to account for this as an equity settled plan or a cash settled plan. With that, we are on the topic of valuation.
Okay.
And I think I will leave the word to Sam here.
Okay. I see still there's a comment. Handout seems to be the slide of the first, but there's a second handout now added, which is it's mentioned in the name session 2, which is a session for today. Okay, let's start with valuation. Valuing stock options can be very simple. I think everybody knows a Black-Scholes, or many of you may know a Black-Scholes model, which is actually, from a logic and from a calculation point of view, very simple. But in many cases, options are not straightforward, or stock option plans or share appreciation plans or whatever you call it are not obvious, and then you will need to go to a more complex model, and that's something we will further discuss now. First of all, what is the fair value of an option? That's classical, that you know, is that fair value of an option is not only the intrinsic value. The intrinsic value is the share price minus the exercise price at a certain point in time. Today, at grant date, for example. In many cases, the intrinsic value at grant date is 0, because normally the exercise price will be based on the share price at a certain point in time. There can be a little difference, because very often, like in Belgium, share option plans, the share price is calculated as a weighted average of 14 days prior to grant, for example. The exercise price, I mean. But the share price for valuing, you always look at the date itself. So there may be a little difference sometimes also in Belgium stock option plans. But then you have also a time value, and time value of money is based on today and based on certain parameters. What is the potential of the shares, and what is the time value over the time, over the maturity of the option? Parameters that will significantly influence, significantly is the volatility of the share price, that I will show you later on. This has a significant impact on the time value. The higher the volatility, the higher the time value. The interest rate, or the discount rate, the risk-free interest rate actually, that we will use, that has an impact, but has not a significant impact. The time to expiry, the term of the option, expected term of the option, has a significant impact. The longer the expected term of the option, the higher also the value of the share, and also the dividend rate. The higher the dividend rate, the lower the value, because you will pay dividends and that decreases your share price. Of course, there's some other elements that will also influence the option plan, and basically that's certain non-standard conditions that you need to consider. The vesting period is clear, but it's also what are the exercise periods? Very often you have certain slots of exercise periods. You can only exercise when the options are vested, and then you can exercise every time the month after. In that month you can exercise for a period of 3 years, but only in that month. And this may has an impact also on the valuation, because you have some restrictions on exercising the option. Sometimes there's some early exercise. For example, that you also sometimes see is that stock option plans has a change in control clause, where upon a change in control of the group, there's an accelerated vesting, which and allows to exercise early. That's something you may need to consider. Non-transferability. Normally options you cannot transfer. They're not freely traded on the stock market. Even general option that you buy for shares that are public, those are freely traded, but those are not in. And also the underlying share may not be freely traded if it's a private company and not a public company. Things to consider. And then finally, there may some performance hurdles. Performance obligations can be a market or a non-market one that has certain hurdles that you need to meet certain thresholds, a certain KPI, for example, until it will vest. So the vesting period may often be based on the service, but like already explained previously, a vesting period can not only be service, but can also be a non-market performance conditions, which can be the achievement of a certain KPI. It can also be a market performance condition, which can be achieving a certain level of the shares. What is important is that I'm not sure if it's already told, but when it's a non-market performance condition, or it's just a regular service vesting conditions, that's something you will not initially consider in the valuation of your option. If it's a market performance condition or a non-vesting condition, a non-vesting condition is a condition that's not directly related to the vesting of the option, and that the person has no influence on the vesting. That's a non-vesting option. Those items you're considering into the fair value of the option. So the market performance condition or the non-vesting condition and all the rest. But often you need to consider also the expected vesting period, and I will show you that later on into an example. So it's not saying that it's part of the vesting we do not need to consider, but sometimes in estimating the time value or the option value, you will have to consider also. I think that's easy. What is the impact on the fair value of the option and on the change of certain parameters? The higher the share price, the higher the option value. That's I think a logical one. The higher the the higher the exercise price, the lower the option value will be. So I think that's also because the intrinsic value will already change. If the share price increases, that will increase, but if the exercise price increase up to the level of the share price, that will decrease it. It's not offset. That's something important to know. It's not automatically the increase. If it's with the same amount, the increase and decrease is not offset, but it will decrease again the option value. The higher the volatility is the expected changes in the stock price at certain points into the future. It's always calculated based on historical data. The higher the volatility, the higher the option value you will have, because we will have more options that, we will have a higher increase in share price into the future expected, or exercise price stays the same. So this will end up into a higher difference, a higher future intrinsic value, certainly higher time value, and that will increase the stock option price. The time to expiry, the maturity, normally increase it. Depends a bit also when you're valuing an American or European option. A European option is only exercisable at the end of the option. An American option is exercised at any time. What we see very often is that we have a certain type of European options always. It's rare that we see that as of the beginning, the option can immediately be exercised and can be continuously over the term being exercised. That's an American. European, why I say it's a kind of European, because it's not only at the end of the term, but it's at certain points in time. So it is a discrete schedule of exercise periods that you will have. That's kind of European. The higher the interest rate, the higher the increase, the higher the dividend yield, the lower the fair value. And other factors, non-transferability will of course lower the value, because non-transferability will also decrease the share price if it's a private company. You will add a discount for non-transferability. Continued employment requirement will also lower, because in that case very often you cannot exercise. So normally, no, what I was telling was not correct about exercisement. And why is that? Because continued employment, it is an additional hurdle. There will be more limited cases when you can exercise. That will decrease the option value. And the periods in which exercise is restricted normally will have a negative value, but it's really limited in an efficient market, of course. And that's not always the case that we have that. That's something to know in mind. So if we look now to the three types of valuations model. The first one that most of you may know is the Black-Scholes-Merton formula. It's very straightforward. It's a formula. You can find it in Excel. You can look up some websites. It's where they have a kind of model. You enter the parameters and it will calculate. Now, what is important to know, when should I use the Black-Scholes-Merton formula, which is, I think, in 75% of the cases used when valuing stock options, straightforward stock options. So it's very common used in assessing the value of freely traded put or call options. And you can also incorporate dividend yield. So a company who has a history of paying out dividends, it can be included. But what are the conditions? Normally, it's only valid for European options. So the Black-Scholes formula in the methodology expects that the exercise can only occur at the end of the term or the expected term. It's very difficult to include market conditions or non-vesting conditions into a Black-Scholes because it has limited. It needs to be a very standard option. We will see that later on. There's no consideration for a blackout period. When you have blackout because I cannot exercise and I cannot sell my shares, for example, that I after exercise, that there's no consideration paid for it. You cannot foresee that, although that's not very common. And the volatility and risk-free interest rate is constant. So you will not be able to estimate, for example, like we are in today, that you're going to estimate that interest rates will continue to increase, or volatility is now high, but we expect after 2 years, because after 1 year we expect that we will have a mature product that will deliver constant revenue streams that may decrease your volatility because the risk of the company is decreasing. Volatility decrease, that's something that you cannot foresee. That's something you will perfectly be able to include into a Monte Carlo, where I come back on that later on. For those who like statistics or technical formulas, that's a formula of a Black-Scholes-Merton formula, of a Black-Scholes calculator. I will not go into detail, but that's how you see it. But I will show you also an Excel, and we can share that Excel also afterwards. I will send it. It's not included in the handouts, but I will send it to all of you that you can use. But for example, go to an example, and I will go immediately to the example. One moment. Where is the Excel? Yeah. Here you see the Excel. Let me put it a bit bigger, maybe. One moment. Okay. So we have a share-based payment plan and also warrants issued, not options. Warrants give rights to new shares. Options give rights to the counterpart is an existing share. That's the difference in name between a warrant and a plan. It's very straightforward, and we will have to work. For example, we have to have a service condition for 3 years that we need to have. The term of the option is, or the expected term, and I will come back on that, is 5 years. Very often in Belgium, the legal term is 10 years. But I will come back on the parameters, because this is an important element to use. And we will use the Black-Scholes formula. So what are the parameters? First of all, we have the stock price. You need to value an equity settled plan. You need to value at the grant date. The grant date is when, I think, which was explained in the first session, when both parties mutually agree on the terms and conditions. Very like in Belgium, normally you think that's after when you have accepted the stock options. But you can have a pragmatic approach and determine, because they have, I think, 1 month in Belgium to accept options, that you have a middle, or it's something you need to be consistent in applying. You don't need to, because you have of one plan and 10 different dates that the stock option was accepted. You don't need to value at 10 different dates. Theoretically, you should have, but I think you can apply a more pragmatic approach for that. You need to determine the exercise price. The exercise price is coming from the terms and conditions. In Belgium, again, it's based also on, there will be an audit opinion of the statutory auditor that will confirm or that will advise about the exercise price. But the exercise price, again, is very often based on the share price at that date. And it's calculated, again, based on a weighted average over a certain period of time just before the grant date. That's also why you see here a little difference, 240, 241. It's just 241 is really at 30th of December 2020. 240 is based on the average. So we have already immediately an intrinsic value of 1.9, the difference between both. The term of the option. If you look to the standard will say, well, you need to use the contractual term. The contractual term is very often, like I said, 10 years. But it's a Black-Scholes, meaning it will assume that you will exercise the option at the end of close to the 2 year 10, which is not really realistic sometimes. And that's very often they're not waiting, also because in my case, the vesting is 3 years. I need to be employed for 3 years. As from year 4, I can start exercising it. So what is in general, what we recommend, and it's also foreseen in IFRS 2, is that you estimate the expected term. Normally you will use historical evidence about estimates. Do we see that when it's vest that within the year they normally exercise? Of course, it will depend on the share price at that time, if it's in the money or not in the money, etc. But you need to do an estimate. And I think it's fair to shorten. Again, the longer the term, the higher the fair value of your option plan. But here we very often use the expected life of the option until exercise. Then we have the volatility. Volatility, if you're a quoted company, it's not so difficult. And then you have already a long history. You calculate, for example, here, I have here the Finvision share prices. I have a history of a couple of years already. You calculate here the volatility. How do you calculate? I have here the closing. For each date, I have the last date, which is my grant date here that I have, and I will determine the reference period. Here I will take everything, the history until when we did the IPO, I will include everything. So we'll include, in that case, more than almost 3 years of history of data. That's something you can consider. The standard doesn't say you need to use 3 years. You can use 1 year, you can use 5 years, but you need to be consistent about that. Then we will calculate the standard deviation. We will calculate the standard deviation of the log normal flux between the close, and that's the log normal flux between the closing price just before and after, before the date and at the date. The log normal, the log normal, and there the standard deviation calculation. This is the daily volume. And then the analyzed volatility, assuming we have 252 trading days in a year. We need to use a year, not 9/11, because it's an analyzed volatility. We go from daily to annual. We need to calculate, and it's a bit blocked now. We need to use the square root of daily volume. So it's the standard deviation multiplied by the square root of 252. And for some reason, my computer is blocking. I hear this now. You see, it's the formula is the standard deviation over the 911 reference points, or the square root of the number of trading days. And you have your analyzed volatility that we will use. Let's go back, and here we have the analyzed volatility. Very often, if you're a private company, you don't have your own reference points because you're not quoted, or you maybe you did an IPO and you just have only a quarter or 6 months reference of share prices, which is not reflecting, which is not a good basis. In that case, normally you will determine peers. So you look for peers, quoted peers, of course, of your company, and you will use the peers to calculate the volatility. And you may have a transition when you're just public, not enough reference. You can include your 3 months. You will include peers, and as soon as you have sufficient reference, you can continue with your own shares and not looking to your peers anymore. But normally you need to determine your peers in the same market and determine the volatility on the same basis that I have showed you how to calculate volatility. The annual rate of dividends, very straightforward here. That's an estimate, but also based on historical evidence, and depending on your company, depending also on the strategy of your company. Do you want to do you want to issue dividends, a dividend return to your shareholders? Like if you look to a biotech company, they will never have a dividend yield. They will never have the option to distribute dividends. If you have a mature company like NG, for example, or Proximus, yes, of course, they will distribute dividends. So that's something you need to include. Then you have the discount rate. Discount rate, you look to the entity. It's a Belgium. We are a Belgian company, and we use the Belgian five-year bond yield. Why 5-year bond yield? 5 years, because we match it with the term. If we would have 10 years, we would use the 10-year bond yield. If I'm a company in the US, I will use the US bond yield, and that's something clear. There's some discussion sometimes, do we need to include negative interest rates or not? I think in that case, you need to include negative interest rates, because that's reflecting, that's a fact, and it's influencing the stock prices. It has an impact on the evolution of the stock prices as it is. Which may be different in some other cases when you calculate, for example, a WACC for other purposes. And there the contractual life, but that's not used. And then you have here the formula, that's a constant. Here you have a formula that's using the things. I will not explain in detail the formula. It's very straightforward. And it will calculate, in that case, a call option, but also a put option value. Not a written put option, but when you have a right, that's a call option and that's a put option. That's sometimes also useful to have a put option when you may have issued for other transactions in an acquisition, for example, certain put options on certain shares, own shares, or you may have written a put option, and that helps also sometimes to have a value. All right, so that's our value of the stock option here is 112. That's a call option. That's the value of the fair value. If it's equity settled, you calculate once and that's it. Like Andres has explained, if it's cash settled, you will calculate this here at every reporting time until the liability is extinguished by paying, or when the option has been expired. Of course, in cash settled, what you will see here is that your exercise price stays the same, but your stock price may be increasing. It can be that it went up with 1.5. There you will see what it will mean. Intrinsic value increases a lot, and you see the option from 112 to 206 that it has. It's not only the difference that has been added. It's not exactly the one. It will be a bit higher even. All right. I get often the question: can we use the Black-Scholes model because we have issued a plan where the employees will receive not an option but immediately share prices for an exercise price of 0. Can I then use the Black-Scholes? No, you cannot use a Black-Scholes. The Black-Scholes always need to have an exercise price. If you will add 0 here, you will see that the exercise price, you will have an error because in the formula you cannot divide by 0. But I will tell you, in that case, the stock option value, the value of this is the share price. And how can we simulate that? I do 0.0001, which will work. And there you will see that it's very close, or it's actually the stock price. So in plans where you issue immediately or you grant shares at a certain point in time when vesting conditions are met for a consideration of 0, the share price is your value that you will use in the equity share-based payment plan. All right. Okay. Good. Then we'll go to a next model. That's a bit more complicated, but still okay. That's what we call a lattice model. A Black-Scholes model is a closed model, what they call closed, because it has certain parameters and a lot of limitations. It needs to be a standard product. A binomial model is able to deal already with certain complexities, and that's what we call one of the lattice models. So you can use complex options with certain market performance obligations, conditions actually, not obligations, but that's a typo. It should be conditions. For example, I have a stock option plan, and one of the conditions is, besides I need to be working continued employment for 3 years, is that the share price need to be at 20. And currently it's 10. If it's below 20, I cannot exercise. If it's higher than 20, I can exercise. And that's what we call, that's a market performance condition. Market performance, because it's directly the performance and meeting this condition is directly related to the share price of the company. It can also be an indirect parameter, directly, but it should be indirect, but it should be directly influenced by the share price, or an alternative measure to value the equity value of the company. For example, a multiple very often is also considered as a market performance obligation. All right, so what is a binomial model? And I will show you. It's very flexible. It's an iterative approach. Like it said, binomial, it has 2 options. It can increase or decrease. That's it, 2 options. That's, you will see it into a tree. It's a very iterative approach because you will calculate it on a number of timestamps, a number of time points, it will normally we use it when we need to estimate a flux of the fluctuation of the share price. But let me show you here on the next thing. Don't look to all the details, but I will explain to you how it works. So what we do it now once on 5 years. Have a 5-year period. What you see is the life of term is 5 years. 5 years, we have 5 calculation points. I will put my spotlight on. We have 5 calculation points here. Year 1, 2, 3, 4, and 5. First of all, what we try to do is I start with today. Today, the share price is 10. What do I expect after year 1? That's a gray area. I expect that it may increase or it may decrease. There's a formula behind it here. You see that here. That's the formula that we will include. I think it's 62. I need to look for which item now it's mentioned, but actually it's the formula here is that's an upward movement and that's a downward movement. You see here the upward movement, there's a probability of upward movement, but the upward movement is also calculated let me see, 62. I will share with you the exact formula here, but it's an upward movement, downward movement, and we have a probability. A probability of the upward movement is 0.40%. The downward movement is 60%. That's how we calculate. Then we are at year 2. I can have again an upward movement and a downward movement of the share price, and that will continue. So we will build a tree over 5 years. In that case, minimum 5 points. Very often, we will not only include in 5 years, we may do it on a monthly basis. So meaning we'll have 60 calculation points, or 3 will get bigger. But once we calculate, at the end, we come up with certain share prices. And then we determine what is the intrinsic value, because I will exercise after 5 years. And what is the value? I have an exercise price of 10. So the intrinsic value here is 111, 121 minus my 10, which gives me 111. Same thing here, 44 minus 10. Here also, this is out of the money. My exercise price is 10. The fair value of the share price is only 6 after 5 years, so it has an intrinsic value of 0. Okay, once we did that, we will recalculate every time. We will recalculate every time. We'll go back. So first we go up, estimate the share price, estimate the intrinsic value, and really go back again. What is the value of the 63? The 63 is 111 with the probability and 34 with this probability. You come up with 63. Of course, because this is calculated with the same things, this will also be the same as minus 10, and you will continue. So certain elements will have 0 or slow amounts. Here, for example, you have 0.97, because I have here 40% of 2.51 and 60% of 0, give me an average of 0.97. You will recalculate. There's also a discount included in here. If you would calculate, you see the formula. Of course, if it's 1 year, you will continue to discount it to 5 years to today. So it's a present value. And the 4.42, which is the fair value of my option, is a discounted of all the different exercise prices, the notes here, multiplied by its probability. So it's a weighted fair value of all the different possibilities that you may have in movement of stock price. And that's, for example, one that's allow you when, for example, certain the number of options that will vest depends on the share price, for example. That's how you can calculate, because here you estimate the share price, they can determine how many options will vest, and you can determine your amount like that. So that's a way to do this binomial model. Again, I think you need to use more nodes here, and not only 5 years. The more nodes you use, the more accurate the fair value will be. If you use the same terms, very often it will equal very close to a Black-Scholes model. Okay. Okay, that's a binomial model, quite often used. It's not so difficult to build that also into Excel. You see a tree in Excel you can easily build. It makes your Excel rather heavy, that's true, but it's certainly possible to do that. Okay. And then we go to a more complicated one is a Monte Carlo simulation. Monte Carlo is very often used. I think Black-Scholes 57%, Monte Carlo I think 15%, and binomial I would say only 10%. Why is a Monte Carlo used so much? Certainly once you have non-standard conditions into your option, a Monte Carlo simulation is very flexible. You can build it in Excel, but there's also tools. You can use SPSS or other tools to calculate a Monte Carlo, but in Excel it's possible. And I will show you also an example. But it's a multiple probability simulation, because we will simulate over a large number of parameters or evolution of parameters, and that give a probability to it, and the weighted average probability of the results give my result. The probability will always be based on a normal distribution. So it's a bit statistical, like Black-Scholes also. Black-Scholes is also based on a normal distribution. It's a statistical mathematical technique, and it can estimate possible outcomes of an uncertain event. Meaning, I think almost all the most complex options with a mix of market performance conditions, non-vesting conditions, other factors, including it, you will be able to estimate. You will be able to use a Monte Carlo simulation. But let me show you also an example. So let's assume, and I will show you the Excel immediately. Let's assume here that I have an options, and the option that vests, the number of options that vest depend on, first, there need to be an exit. The exit is defined in, for example, a shareholder agreement. And once the exit is met, the number of options depend on the investment multiple that is achieved upon the exit. Investment multiple compared to the initial subscription price that was paid by the shareholders. This is investment multiple is a market performance condition. Market performance condition, we will include it into the valuation. But let me show you the model and then come back. One moment. There it is. Okay. It's rather complex, but I will show you the logic behind it. I will not explain you all the formulas. But what you see here, it's a Monte Carlo. We issued, the valuation date is 18 December 2022 for the future. My stock price is 989.18. My term is 5 years, and I will come back on the term. And the volatility is 65% based on peers. No annual rate of dividends, and the discount rate is 0%, what I have. And I need to calculate. So the first complexity we have here is, well, I have when an exit will occur. When an exit will occur, how can I estimate that? You can use, well, it's a maximum of 5 years. Okay, I will use 5 years, but that's not feasible. Assuming here we have a private equity who has invested in Finvision, and if you look, private equity always have an investment strategy, and they will start selling after a certain point in time. What we, for example, can do, there's some statistics behind it, is look for what is the probability based on historical evidence over a portfolio of investments that the private equity partner will perform an exit. Exit is selling its shares to another party. It may not be dependent on him, it may also depend on the needs of the company, of course. But let's assume we can use that, meaning that it can occur in term 1, 2, 3, 4, and 5. And that's what you see here, is that we will have 6 terms. We will have 6 years. And every year we have determined a probability. Probability is coming from historical evidence. In that case, it's a management adjustment. All right. So that's the first thing. We will do a calculation based on each expected term and give a probability, and then the fair value will be the weighted probability on the shares. But what is now the term? Because the number of shares that will vest not only depends on whether there's an exit, but also depends on but what is the multiple that is reached by the, what is the multiple upon the exit compared to the initial investment that has been done? And based on the multiple, that will trigger how many shares are vest. It can be 0, it can be 100%, or it can be somewhere between. That's something impossible to estimate using a Black-Scholes model or even a binomial model, because you have, it's not only two cases, an upward and downward movement. There's a lot of, there are much more possibilities. It's multi-dimensional, I can call. Then you need to use a Monte Carlo. So what we did is, what you see here on as column I, is that we will do simulations. In a Monte Carlo, you will do a lot of simulations. In that case, here you can see it, but you have 100,000 simulations. What is a simulation? In that case, we are now at a term of 5 years, and I will simulate the stock price. I will simulate the stock price based on the stock price, the term, the volatility, discount rate. Similar like a Black-Scholes model. But I will simulate what can be one of the stock prices that can be reached. It's not like binomial with ups and downs. It can be, there will be an up and down, but we have 100,000 cases, 100,000 estimates based on volatility, what the stock price can be after 5 years. And then we start recalculating. Then we start recalculating what are the proceeds of the exit, what is the multiple reached. And then based on the multiple reached, what is the, let me move that a bit. What is the payoff? Payoff will in that case be the fair value. So I will calculate, I have a multiple. In that case, there's no, below than 2, there's no options granted. So the payoff is 0 because I didn't reach the target. It should be at least, for example, I don't know, 2.5. If it's 2.5, for at least have a certain amount, it's below, this is all 0, 0, 0. If it's 10, of course, this is a high evolution. You look to the stock option value, it's 36. That's possible. If it's always increasing, it can be 36. Then I will have a payoff of 27. Then the fair value is the average of all my payoffs at a certain point in time. And that's how I come up here with the Monte Carlo. So simulation over 100,000 possibilities of a stock movement. We calculate what is my fair value then of the, in that case, what is my payoff, my intrinsic value. And then that will, the average then of this column give me my 5. This is a model that continuously calculated, because if you see in the formula here, the formula is flexible. So it's with the rand, and you know, with the rand, it's a normal distribution, and we include a random number between 0 and 1, and that recalculates every time. And that rand is also a normal distribution, and that shows you, if I would click, you will see it's changing every time. It will recalculate normally the whole model, you see. So you will always have to fix it. These are fixed now. That what we have. So those are the values we calculate to the Monte Carlo weighted average, and then we come up with the weighted average in that case. All right, but rather complex to calculate, but very flexible model. You can estimate the most complex option types for that. All right, and then we come up with the last point, which are, but what are the disclosures of IFRS 2? And I prefer to show that through an example. And very often, I'm also coming from EY, I'm using the EY guidance, and there's a good illustrative financial statements, which is called EY Group. Let me go to the slides. One moment. Yep. Thought they were open. One moment. I thought they were open. So you see how you can look for it. 2022. That's a good one. That's the one that we want to see, and you download it. It's already open. Okay. All right. So let's go once to do the different slides. I go immediately, where do we see share-based payment? If it's a cash settled, you will see it into the balance sheet, of course. If I go to the balance sheet, but that's not the case here, I think, that we in the balance sheet, I will enlarge it a bit, that we will see in the balance sheet the share-based payment part of an equity liability. And very often this is included also into other current liabilities, other non-current and current potentially liabilities. But let's go to the changes of share-based payment, changes of equity. There we see, often you see a share-based payment reserve. In that case, it's included here in the other capital reserves, where we see the share-based payment and we see the expense. That's the expense relating on the vesting, and all the adjustments that we will include is a 307 here. That's one of the things. So again, you may often see that as a separate reserve, share-based payment reserve. Very often you see other adjustments here, which is when the options are exercised, you may see a reclass from the other capital reserve to share premium, for example, or to another reserve because the options are exercised and they're not existing. Another case can be is that every time there's no reclass done. This is all accounting policy. If you now go to the accounting policy, page 52. Yeah, here it is. You see here the accounting policy of share-based payments, where we have the accounting policy for equity settled and also for cash settled transaction. Only include those that are applicable. So avoid being a boiler template, being very specific. Explain the accounting treatment of the transactions that you have. So again, if you don't have cash settled, you don't need to include, of course, this into your accounting policies. Also explain where you will recognize the expense, at what line into the P&L this is expensed. If you will reclass your share-based payment reserve upon exercise, also in between your reserves, explain also here how it will work. The rest is rather standard guidance that you need to include. A second item which is important is in the significant adjustments, in the significant estimates and adjustments, where we, of course, you have seen it when we use, first of all, a judgment may be done on what valuation model we need to use. The valuation model, do we use a Black-Scholes model, or do we use will we use a binomial or even a Monte Carlo model? That's a judgment being done. And then also about the inputs. So you will have to estimate the inputs. Even if it's a Black-Scholes, you will estimate the volatility. You will estimate the term of the option. So those are significant estimates, and that's something you will need to explain into your significant estimates, what you see here, and then referring to the note where you have all your assumptions and the model explained. If there's no, you see, there's no need to explain all the inputs here. You need to mention them. It's okay to reference to the note and where those are explained. We think we need to avoid repeating in several sections of the financial statements the same information, and that's often what you also see. They were repeating all the inputs, etc. But that's my opinion, and that's not. And you see that also here. That's not a real requirement. You need to say what are the estimates and where can I find the estimates. Okay, and then we go to note 33. That's a very far part into the financial statements. We go after the pension liabilities, and here we have the share-based payment. So first of all, what is the requirement? You need to explain the plan. You need to give a detailed explanation about every plan that was issued. Very often we have one plan, but you may have several issuance over a period of time. That's okay, you only have one plan. But you may also have different plans with different terms and conditions. So you need to explain it differently. And that's one thing. Explain the terms and conditions of each plan. In that case, you have a senior executive plan, and we have a general share option plan for all the employees. And also a share appreciation rights, the SAR, what we call. Very often also SARs or in cash, because it's based on the share price that you will receive a certain amount in cash when exercised or at a certain point in time, or when the vesting conditions are met. There's often even not an exercise price or exercise periods. Then if it's cash settled, of course, I think you need to make a distinction between equity settled and cash settled plans within your disclosures. Here, that's cash settled. You mentioned also the liability, and in equity settled, you don't have a liability. Also explain where the liability is presented. I don't see it here, the carrying amount of the liability. Maybe it was in the accounting policies, but I think you need to explain in what line of the statement of financial position this liability has been included. You need to explain what is the expense we have recognized over the two periods here, 22-21, expense for equity settled and cash settled transactions. I think the good thing about the EY group is, but I think it's also with the other from the other big four, is that they make reference to the where can I find the disclosure requirement, and that's where you see it. You see it. They will have the movements during the year, and here what we see here is we have outstanding 1st and 31st of December. I will have a movement. I start at 2021. I have the granting, which has been granted. I have those that has been forfeited, which is explained by Andres. You can also have a line for cancellations if that would be the case. Those that has been exercised and those that has been expired. The contractual term of the option has lapsed, and those who are not exercised because they were not in the money, for example. So those are the different lines that you need to show. What you see here is also that we have the weighted average price. What you need to do here also from every time is the weighted average option price. Mention what is the price here of the options. For the exercises, you see here the 1 and the 2. Normally I don't use it with the 1 and 2, but I include really also a table. You need for all the exercises, you need to mention, also disclose what is the average share price that was applicable when the options were exercised. Why is it weighted? Because I have multiple exercises over a year, and the number of shares that were issued were also different. So you need to weight it based on that. What was my weighted exercise price? In that case, you see, with 1, my weighted average share price was 4.9, but my weighted exercise price was 3.08. And this is the exercise price here, weighted average exercise price. Sorry about that. So my weighted average exercise price was 308, and my share price. So there was already weighted an intrinsic value of 1.01 in that case. Okay, that's one thing. The movement table, often you do that per type, but that's not a requirement from the standard. But very often you see that they have a general one, and then have it by plan. They will have also a separate movement table. And then you need to have your options that you have used, the model that has been used in this here. If it's a SAR, of course, you may have, it will be different, because for the same model, the same plan, it will change every measurement period. For an equity settled plan, it will always be fixed one time. Also, you need to include the weighted average remaining contractual life of the share options, and the weighted average fair value of the options that you need to calculate. What are the ranges of the exercise price of the and the ranges of the exercise price of the option, the minimum and the maximum between the different plans that were exercised, that were in place at that time. Okay, so that's it a bit about the disclosures. It's sometimes not so, I think, from your Excel, how you're measuring it, it should be something that that should be obvious to include, and certainly also the movement tables, or you may have a software to track all the share-based payment plans that you can use in order to prepare the disclosures. Voila, I think we are at the end of our webinar. I don't see any questions anymore. Okay, so thank you very much. I think we are good on time, 5 minutes before. Don't forget our new webinar on IS24 related parties at November 10th. If you're not registered yet, it's not on IFRS 2. There's again a typo here. So see you next time. Thank you very much for attending, and have a good day. Bye-bye.